Hi, ladies and gentlemen, it's the Forex Daddy Bliss $1 billion Zambia's finest trader. So we are moving on to another step, and of course, just like it is in life, when you go to a new place, for example, if you leave Zambia and you go to China, you'll be required to learn their language so that your communication can be effective. So even in Forex, it's important that you understand certain terminologies that are used. So in this section, we're going to be learning some of the terminologies that we'll be using in our trading, but of course, other terminologies will be learned as we proceed. So without wasting much of the time, let's get started. So the first term is called trending. Now, this is a term that you are probably familiar with. If you use social media, you are very much familiar with this word. Unlike the way it is used when it comes to like social media and the like, in trading, it means something different. For example, when some topic is being talked about a lot of times, people would say it's trending. And in Forex, it's different. In Forex, trending is simply a market that has direction. Now, in trading, the market has direction if and only if it is moving either upwards or downwards. If it's moving sideways, we don't consider that as a market that has direction, right? We shall learn about, those things later on. But if the market is trending, then it has direction. And now this direction can either be upwards or downwards, right? That's that. Let's look at the bullish market. Bullish market is simply the market that is moving upwards. So, ladies and gentlemen, when we say the market is trending upwards, we simply mean the market is going upwards, right? We simply mean the market is going upwards, right? As easy as that. So, a bullish market is a market that is going upwards. So, a bullish market can also be called a bullish market or an uptrend or upward trend. The next one is bearish market. The bearish market is simply a market that is moving downwards. So another term for a bearish market is called a downtrend or downward trend. So now, when I say go long on a particular pair, for example, I tell you go long on Euro USD. What I simply mean is that buy Euro USD, right? That's what I simply mean. Say buy Euro USD. That's the whole point. When I tell you go long on Euro USD, it means buy Euro USD. So you can either say buy Euro USD or go long on Euro USD. It's one and the same. But just for the record, there's also a term that we call to go long. It simply means to buy. Another term is to go short. When I say go short on Euro USD, I'm simply telling you to sell Euro USD. Now, it's not a problem when you just say sell Euro USD. It's one and the same, except in trading, we also have these terms, but you can use whichever you prefer. You can either say short Euro USD or sell Euro USD. So the other term is bull. So the bull, in real life, it's we're talking about some sort of a cow, right? But in trading, a bull is simply an investor who takes buy positions in trading, right? So if you buy Euro USD, so you are a bull at that particular time. The moment you take that buy position, you'll be called a bull, right? Then bear, from the term bearish, when you're a bear, it means you have taken a sell position on a particular asset. So I won't talk about the hawkish, dovish. This is something you can do at your own time. Allow me to talk about an acronym that is very famous in trading. It's called NFP. NFP simply stands for non-farm payroll. And this is an important news event that is released from the United States on first Fridays of every month. It is a news event that traders would, based on how the news will be, people are able to take trades. So sometimes when certain news is released, it can change or rather cause a retracement in the direction of the market. You'd find that, for example, if the market is moving upwards and then at that particular time when news is being released, it goes in a different direction. So that is how powerful some news are, right? So as a trader, there are people that trade based on news. There are others that don't trade based on news. So as it is at the time, I don't trade based on news. If I have to trade based on news, I trade after the news has passed, and then I'll catch a trade after the news. After the movement of after the impulse movement during news time. So that's non-farm payroll. So it's an important event in the US and to us as traders. Now the other term is called ranging. Ranging. A market is said to be ranging if it does not have a particular direction. Now I said the direction in trading is either upwards or downwards, right? So if the market is not neither going upwards nor going downwards, it is said to be a ranging market. So when the market is moving sideways, it will be called a ranging market, right? Yes, so a ranging market can also be called a sideways market or a consolidation. Those terms mean one and the same thing. So other important terms that we'll be learning in trading are support and resistance. So you'll probably be learning these terms for some time until a particular level. So support is simply a price level where buying is strong enough to interrupt or reverse a downtrend. So a support level is simply if the market was going down and then it reaches a certain point and begins to go up. Now that point where it reached to start going up, that is a support level where it changed direction from. Resistance is simply a point in the market where the market changes direction to start going to the downwards. So if the market was going upwards and it reaches a certain level, it begins to fall down to go down, then that point where it has reversed from is the resistance point. Now here's an illustration. So we can see the market moves some sort of a wave. So this one is going upwards. So from here it's going upwards. So the fact that here it tends to start going upwards, this is a level of support. And from here it fell down, this is a level of resistance, then goes up. So meaning this level is support. Then again here, this is level of resistance, just like that. So I hope you get the general idea of what support and resistance is. Now, when the market is moving sideways, it will be something like this. So this point where it's reversing from is resistance, and then this point where it's reversing from to go upwards is support. Many people do use these concepts to actually determine when to buy and when to sell. For example, when the market reaches at resistance, people would be taking their sell positions. When the market reaches at support, people would be taking their buy positions, because you know at that particular point there's a likelihood that the market would change direction. Now we shall learn about support and resistance later on, but here is a real chart example of support and resistance. So we see the market reverse from here, reverse from here, reverse from here, reverse from here. So this is a level of resistance. The market reverse from here, here, here. As you can see all these points, so this is a level of support, right? So let us now move to two important terms, and these terms are bid and ask price. So I don't know if you've ever gone to the bank, but if you have probably seen or where you go and you see some numbers changing, and on one side it will be written buy, and then on the other side it will be written sell. In trading, this is what we call bid and ask price. Even in the bank, that is the bid and ask price. Yeah. So these are simply prices that tell you at which rate you are buying another pair, at which price point you are buying another pair. For example, if you have the kwacha and the USD, you probably know that at some point people will be like, okay, the kwacha is buying at this rate, the dollar is buying at this rate. So those two prices that they tell you, one is the bid price and one is the ask price. So now let's understand which one is the bid price and which one is the ask price. So if you open your MetaTrader 5, you should have downloaded it on your phone or on your computer. It's actually very free. Or MetaTrader 4. I'll talk about these platforms later on. So you see these are pairs listed. They come paired already. So the bid and ask price, these are the numbers that are circled, right? So we can see these numbers are similar but not the same. The difference is very small. This is 110.57, this is 110.58, right? So you see the difference is very minimal. So one of these numbers is a bid and the other one is the ask. So let us understand which one is the bid and which one is ask. So the bid price is simply the price you sell an asset at. Then the ask price is the price at which you buy an asset at, right? So if you're buying the kwacha, you are using the ask price. If you are selling the kwacha, you are using the bid price. So when I say the kwacha, you can actually just put in, depending on where you're watching me from, you can just put in your local currency, right? So when I say I want to go long on Euro USD, it means I will enter the market with the ask price because you want to buy. So meaning at that particular point, you use the ask price. The opposite is true for the bid price. So how do you know which one is the bid price and which one is the ask price? You just look at which one is bigger and which one is smaller. So the bid price is always smaller than the ask price. So look at these numbers. This is 110.57. This is 110.58. So you see that this one labeled in red is actually smaller than the one labeled in blue. So this one is the bid price and then this one is the ask price. If we look at USD card, 1.4385. So this one is the bid and then this one is the ask price. When you go to the bank, when you see buy, that's the ask price, then sell, that's the bid price, right? Yeah, so the next time you go to the bank, please be observant and look at those things. So let us look at another part which is also important, and that part is the spread. So what is the spread? So now spread is simply the difference between the bid and ask price, right? So when you get the ask price, when you get the bid price, you subtract it from the ask price. What you get is a spread. For example, let's look at this illustration. We have this number is the bid, and then we have this number is the ask price, right? So here, the thing is that when you subtract this number from this, what you get is the spread. But then the spread is actually measured in pips. So what is a pip? A pip is simply a unit of measurement in trading. For example, if you have to measure distance, you use miles or meters. So in trading, we don't use meters or centimeters, but we would say pips. So if you can calculate the distance from one price point to another price point, you just need to subtract, and then what you get is the number of pips that price moved from one point to another. So whenever you are measuring distance or the movement of the market from one point to another, we use what we call pips, right? So when you subtract the bid price from the ask price, what you get is the spread. That is how yeah. So that's that, ladies and gentlemen. And of course, I have to mention that the spread is actually where the brokers get their commissions from based on the spread. So you always have to ensure that when you're trading an asset, the spread isn't much. The spreads should be low. That is also one of the things that you should consider when choosing a broker. You need to ensure that the spread is low. Yeah. Otherwise, that's it, ladies and gentlemen, for this. We shall continue later on a new chapter and a new topic. But for now, that is it. And of course, I look forward to another lesson. So, well, I'll see you on the other side. Yeah.